Ladies and gentlemen, happy Friday. It's Friday. Gotta get down on Friday with a little bit of Prince Ali Fabulous He Alibaba stock. Okay. So, this is one of my favorite positions in the value portfolio. We have 100 shares, average price close to the $80 range, and even at this relatively low level for Alibaba, compared to their all-time highs in the low 300s, we waited until there was a low point, and that's when we began the process of selling puts. We sold puts from the mid 80s all the way down to the $58 level. Only got assigned the one lot of shares, but collected a lot of premium along the way. We're happy, all right? But Alibaba has a lot of hidden potential and value left to unlock over the next couple decades. This is essentially my bet on the Chinese economy and the growth of the Chinese middle class. Their per capita GDP is somewhere in the $12,000 to $13,000 range compared to the $70,000 to $75,000 range for the United States. What this means is they've got a lot of room left to run still. As that per capita GDP grows, so too should the disposable income per household, which means they'll have more money to spend on products offered by Alibaba. So, with that being said, there are risks, geopolitical risk, the government of China, risk of, making some new rule that's not favorable to Alibaba, and they can pretty much do so whenever they want. They're, not necessarily as business friendly as the US is, although they've become more and more business friendly, I think, as time has gone on over the decades. So, they like having a strong, healthy, growing economy that's prosperous and taking the credit for it. So I'm hopeful that that will continue into the future. And as far as the geopolitical risk of, a hot conflict, if the US and China got into a hot conflict, we would have much greater worries than how red or green our portfolios are at that point. Our physical safety would be threatened. So, that being said, I think that the potential rewards probably outweigh the risks here. Now, they're implementing a $40 billion buyback program, which, as of the current levels, represents about a sixth of the shares outstanding. That would be massive as in terms of value added to shareholders. Now, beyond that, they are also splitting their 6 divisions into separate businesses that will run each as its own self-contained business, which may or may not be super accretive, but we as shareholders may benefit if that sparks each division and pushes it to perform better, and may help with the so-called conglomerate discount, where for some reason, when multiple different types of businesses operate under one umbrella, you end up having like a lower face value share price for the overall entity than you would if you split them up into their own businesses. Now, as a value investor, I kind of like the conglomerate discount because it means I can buy more cash flow for less. And, I view every investment as basically just a stream of cash flow that I'm purchasing. And obviously, if I can buy, a stream of cash flow that's worth $10 and buy it for 8 or 9, I'm happy. I'd rather, not have to pay full price, full value for it. But that being said, I've already got shares here. So if something happens that helps that share price appreciate, I won't necessarily complain. Now, when it comes to a fair value for Alibaba, there are a few things to consider. One, factoring in the risk and the fact that I want to be a value investor. And again, buy something that's worth $10 for 8 or 9 instead of full price. I'm applying a higher discount rate. Okay. We are also just starting from current levels of free cash flow. We are not adding in tangible book value because with the ADRs, there's I was reading something about it where there's some kind of thing where the ADRs entitle you to a share of the cash flow, but not to the balance sheet. So we will just say, okay, the balance sheet is a good thing. It means that the company is very likely not to have any kind of risk of bankruptcy or anything like that because they have a strong amount of assets on the books. But we can't really say, well, we own a piece of that necessarily. Okay, so we won't even give them that. And we will slow down their free cash flow growth rate, which over the last 10 years has averaged 25% or higher. We are going to slow it down to 9% for the next 10 years, 5% for the following 10 years after that. Meaning we're basically assuming that the slowdown in Alibaba stays pretty darn slow. Okay. Now, these are probably more conservative assumptions than I think most, we'll call them Alibaba bulls, would make. Yet, here I am, making those assumptions, even though I think this is a fabulous business. But even still, even with these very conservative assumptions, with a much higher than normal discount rate, okay? Remember, the S&P, over the last 40 years, it's been like 10%, okay? So this is requiring a rate of return of 50% more return, because 50% more than a 10% return is a 15% return. We still come out with a fair value of $122.93, meaning buying it today, you would get basically the stock at a margin of safety of 25% if you demanded a 15% return and believe in the growth assumptions for the free cash flow. Now, could something go wrong and this number end up lower? It could. Could end up a lot lower. But you notice that even with beating it up even more and keeping that 15% discount rate, it still only just eats into our margin of safety a bit. So this, I think, demonstrates that there's just a tremendous amount of untapped value in Alibaba. And if you can stomach the volatility, because every time something is involving China in the news or China-Taiwan tensions, yada, 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 you're going to probably see your share price crater, okay? That's just going to happen. If you can stomach that, and stomach that very, very small risk of something like real actually happening with it, this could be a really, really, really awesome value. Like, this is the kind of stock that, in the long run, really could be one of those multi-baggers that really makes some investors really do well compared to their peers and the market. But you have to be willing to be interested in something when everyone else is negative on it, okay? When Alibaba was $58 a share, it was hard to find anybody with a positive word to say about it. And I was selling puts because I believed that it was a great business with a temporary disconnect in, the share price compared to what it was actually worth. And I think that that's proving to be right. I was doing a similar thing with Meta and just never got assigned shares. So when they were at their lows, these are great businesses that produce a tremendous amount of cash flow, and you have to be able to, if you want to call yourself a value investor, you have to be able to recognize those disconnects when a company still produces amazing cash flow and everybody has negative things to say about it. That is a disconnect. That's just irrationality in the market, inefficiency in the market. Ladies and gentlemen, I personally am so happy that I have Alibaba at the basis I've got it at. And personally, if it ever, craters again, I would probably do the same thing I did last time. Unless something fundamentally changed about the business that made me question whether it's going to benefit, or if something fundamentally changed about the potential of the Chinese economy. This is a very long-term hold for me. I would like to hold on to this company for life if possible. And this is one of those rare opportunities in the market. So if you have any Alibaba stock, I invite you to comment below. Let me know what your cost basis is. Hop on the Discord and talk Alibaba and all the other stocks we cover on the channel with me and with the community. Take it easy, everyone, and have a wonderful weekend. And remember to have your cereal, got to get down on Friday. Take it easy, everybody.